Hey guys, and welcome to your Money Q&A question of the day. I'm your host, Stacy Johnson, and this answer is brought to you by MoneyTalksNews.com, serving up the best in personal finance news and advice since 1991. Let's look at today's question. It comes to us from Suzanne. Suzanne says, Stacy, we constantly hear that there's a stock market crash coming. I'm retirement age now. Please give me some insight into Vanguard's variable annuity. Would this be safer than a 500 index or bond index fund? Well, let's look at a couple of things here. We'll define what a variable annuity is, then we'll talk about their advantages and their disadvantages. Okay, so what is a variable annuity? It's just a mutual fund that's issued by an insurance company rather than an investment company. So a mutual fund is just a collection of stocks, bonds, or both. You get a little slice, you get more diversification that way, it's safer. But this is a mutual fund that comes from an insurance company. Why do we want a mutual fund from an insurance company? Well, insurance companies give us a few advantages. They offer tax deferral. So as long as you leave your money in, you don't pay taxes on the profits. You take the money out, you pay taxes then. They also give us the ability to bypass probate. You leave your money to me, you die, I get the money immediately, it doesn't have to go through court. And so these are advantages to annuities, or to insurance companies rather. And that's why insurance companies issue variable annuities, fixed annuities, and immediate annuities. Okay, but we're talking about variables today. So that's all a variable annuity is. It's a mutual fund, comes from an insurance company instead of a regular investment company. Okay, now, advantages. A couple of them I just told you. It's tax deferred, and it bypasses probate. Also, some variable annuities will give you a guarantee. Some will say, if you should die, your beneficiary cannot receive less than you put in. So let's say you put in 100 grand, the stock market tanks, you die, your beneficiary can't receive less than 100 grand. Now, a newer version goes even farther than that. These are called, guaranteed minimum income benefit. They say, you put in 100 grand, when you retire and you turn that into an income stream, when you start taking it monthly, you can't get less than you put in for that. So you put in 100 grand, the market tanks, it's only worth 80, but then you turn that into a monthly income stream for life, well, it's going to be 100 grand. So that's a pretty good guarantee. That's the idea. So now let's go back to what Suzanne asked me. She said, would this be safer than a bond, regular mutual fund, a 500 index or a bond index fund? Well, when you look at those two guarantees, you think it is, right? And you'd be right, it is. So a lot of times people will want to buy these variable annuities because they know that they're going to be able to get, if the stock market goes up, it becomes more valuable. And so now you got 120 grand you can put into an income stream for life. And if the market goes down, you can't get less than you originally put in. Sounds like a no-lose situation. But let's go to disadvantages of variable annuities. Disadvantages include high fees. You probably knew that was coming, didn't you? Even a regular variable annuity can have management fees of 2%, whereas this 500 index fund from Vanguard is probably less than 0.1. So the fees are much, much higher. Now, start putting on the death benefit fee, and that fee remember I told you you can't get out less than you put in when you turn it into an income stream for life? Another fee. So the fees can be really, really high on variable annuities, especially relative to regular mutual funds. Also, there can be big surrender penalties. If you get out within the first 5 years, you get penalized, even 10 years, some of them. So you've got to be really careful about that. So are they worth doing? They might be. And Suzanne, who's about to retire, might be a person that would want to look at that. If you're really risk averse, you're afraid of your market value going down, and you're going to turn that into an income stream at some time in the future, especially the near future, and you're afraid of a stock market decline like Suzanne obviously is, then this might not be a bad plan. Just go into it with your eyes open. And speaking of which, what Suzanne's suggesting here, she's talking about Vanguard. Vanguard's a great choice. I don't work for them, I don't get paid by them, but I do use them, and they are a very low-cost provider of some of these financial products. So I think Vanguard's a great choice to go to, and one of the best things about them, when you talk to them about variable annuities, you will not be talking to a commissioned salesperson. So no matter who you go to, I am begging you, if you're going to buy an insurance product, a fixed annuity, a variable annuity, an immediate annuity, please don't go to a commissioned salesperson. I know you're going to hate me if you're one of them out there, but I just think you're going to get a better deal by somebody who isn't getting paid on commissions. Suzanne, I hope that helps you. Hope it helps everyone else out there. And I hope that you'll meet me right here next time. Later, guys.